Your friend just texted you a listing link at 9:47 p.m. You open it, and you're staring at a beige, 1,400 square foot ranch in a cul-de-sac you've never heard of. The kitchen has stock cabinets, the driveway fits exactly 1.5 cars, and the listing agent calls it a charming starter home. The price tag? Over $500,000. The math behind that listing is currently punishing. The median home in America right now costs around $488,000. Add in mortgage rates in at roughly 6.3%, and the baseline cost of borrowing is extraordinarily high. If you run the numbers on that median house with 20% down on a 30-year fixed loan and add in property taxes, insurance, and basic maintenance, you are looking at roughly $3,000 a month just to keep the lights on and the roof attached. To afford that using the traditional standard of spending no more than 28% of your gross income, you need to be earning about $128,000 a year. This chart shows the required salary on the left compared to what people actually make. The median American household earns $86,185. That means the typical family in this country is 27 grand short of being able to comfortably buy the typical house. That deficit is a canyon. The bank is standing on the edge of it holding a loan application, but the reality is the typical American family is locked out of the typical American home. Standard advice to buy now is mathematically impossible for the majority. Homeownership, when executed correctly, remains a powerful wealth-building tool. The median homeowner has a net worth 43 times higher than the median renter. However, doing it correctly in 2026 requires meeting a set of precise, non-negotiable financial criteria. Picture the closing table. You are signing 74 pages of documents. Your mortgage broker just made thousands off your loan. The buyer's agent and seller's agent each walk away with 10 to 12 grand. The title company, the inspector, the appraiser, the insurance agent, they all bill you the second you sign. Every professional in this room gets paid the day you close. None of them get paid if you walk away. Their financial exposure to your massive new loan ends the moment the ink dries. When the industry insists it is a great time to buy, they are describing their own risk-free payday, not your financial safety. Renting is like paying for a hotel. You pay for the night and never see the money again. Owning is similar, but it forces you to pay for the building's continuous decay while you live there. This matrix compares your unrecoverable rent against the unrecoverable costs of owning. When you buy, you immediately pay 2 to 5% of the price in closing fees that instantly vaporize. Then you add property taxes and mortgage interest. Then look at the insurance row. Over the last 5 years, homeowners insurance has gone up 46% nationally. That is roughly 3 times the rate of inflation. Those spikes are a direct result of extreme climate realities. Insurers are raising premiums to cover catastrophic risks, which significantly raises the long-term cost of ownership in affected regions. Finally, there is the quiet drain of maintenance. The old 1% rule of thumb is outdated. On a home built before 2010, the National Association of Home Builders now estimates real maintenance at closer to 5% of the home's value per year. Roofs, HVAC systems, and appliances all fail, and you hold the checkbook. When the combined unrecoverable costs of interest, taxes, insurance, and maintenance exceed the cost of rent, renting becomes the more effective wealth-building strategy.
This leads to the first scenario where you should avoid buying. If there is a high probability you will move within 5 years for a job change, a relationship, or family health, buying a house is a financial mistake. The transaction friction of buying and then selling a house strips 10 to 15% of the home's total value. On a $400,000 home, you lose up to $60,000 just to the mechanics of the transaction. Property value increases rarely cover those exit costs in such a short window. The historical appreciation rate of U.S. housing, after adjusting for inflation, is actually between 0.4 and 1.3% per year. Buying a house without long-term life stability ensures those fees eat your equity, turning a compounding asset into an overpriced temporary liability. Banks approve loans based on the debt-to-income ratio, or DTI. This is the simple division of your monthly debt payments by your gross monthly income. This gauge maps DTI against financial risk. A safe, survivable DTI sits between 28 and 36%. However, banks often approve loans up to a 43% DTI, which is the point where they believe you are merely unlikely to default.
Consider a dual-income couple making $138,000 who stretch to that 43% max. They look fine on paper, but when the furnace dies and requires an $8,400 repair, that expense goes directly onto a credit card. If one partner later faces a 20% pay cut, they have zero margin for error. Their housing cost was already at the limit, so this standard life emergency leads to rolling debt and stops all retirement savings. Bank approval does not equal affordability. The bank's math tests for minimum legal compliance, not for your ability to survive life's inevitable chaos. To make an objective decision, you must check your city's price-to-rent ratio. You calculate this by dividing the median home price by the annual rent for a comparable place. This split screen shows why the Mashnan housing market is an illusion. We are looking at two different financial ecosystems. Places like San Jose have a ratio over 30, while cities like Cleveland sit under 15, where ownership costs are much closer to rent. In high-cost markets, a renter who invests the difference between their rent and a theoretical mortgage finishes a 10-year period with significantly more liquid wealth than a homeowner has in equity. In San Jose, that difference can be as high as $600,000. Generational rules of thumb fail because they attempt to apply 1990s Rust Belt logic to 2026 coastal realities. What worked for your parents can financially ruin you today. Before signing a mortgage this year, you must pass this definitive 5-question stress test. Question 1. Will you stay in this house for 5 to 7 years? 2. Will you have 3 to 6 months of expenses left after closing? 3. Is your total debt under 36% of your gross income? 4. Is your city's price-to-rent ratio under 20? And 5. Is your life stable right now? A no to any of these means you should rent. It is difficult to ignore societal pressure and outdated advice from family, especially when it feels like you are falling behind. Choosing to rent and aggressively investing the difference is a proactive strategy to protect your cash flow and build a more liquid portfolio. Real financial security in 2026 comes from recognizing a broken equation and having the discipline to walk away. True authority is looking at the spreadsheet and being brave enough to say no. Hit subscribe and click the bell icon for our next breakdown.